In this afternoon's lecture, we'll just look briefly at mergers and some governance structure that they have in place. And then we look briefly, just 2 slides on corporate control worldwide. So I think in this course, this being our final lecture, we've packed a lot in front. So as we come to the back end of it, it's a lot more shorter and a lot less more to absorb, or a lot less to absorb at this point. On reflection though, when I look at what we would have covered, I think in this last lecture, if I added financial management or financial planning, somewhere along the line, it would be a little bit more valuable. But nonetheless, you're already here, and I guess if I teach it next time, then I would add financial planning. But you can go right ahead. You've already covered, or we've already covered together the basics of finance. So I think it would be easy for you to digest if you look at financial planning. But of course, you can look at those chapters in your own time. I know you're pressured to close off the semester. So take your time. Good. So what is a merger? So a merger is an agreement that unites 2 existing companies into one legal entity, right? It's 2 different companies coming together to form one legal entity. That's a merger. And the slide here shares with you some of the notable mergers that occurred in 2017. And it demonstrates that there are mergers in many industries. You have telecoms, chemicals, semiconductors, pharmaceuticals, railway, food retailing. And it also showed you that, or demonstrates to you that the mergers were cross-border. So while you have AT&T and Time Warner being just American companies, you also had companies such as Bayer, France, acquiring Monsanto, which is an American company. And then you had, like British American Tobacco acquiring Reynolds. So it just shows you that the mergers can be cross-border or within countries, and even cross industries. So the one that stands out for me at the bottom is Amazon. So Amazon is being a company that is strictly based on, strictly or mostly based on the capitalist regime. So they're a profit maximizer. And now they went into the food space and acquired Whole Foods. Whole Foods is, before its acquisition by Amazon, was one of the notable companies who really paid attention to the triple bottom line. So whatever they did in business, they always focused on the environment, the customers, and profits, right? So that is a little eye-opening merger that could have occurred. And then you have the price that the acquiring company paid for those mergers, right? So there are a couple of types of mergers, and these are the main ones that I'm sharing with you. If you open some text, there are some other ones, some other mergers, other categories of mergers. I think you might find about 2 more, but the ones I share with you are the main ones. So there are horizontal mergers, vertical mergers, and a conglomerate merger. In the case of a horizontal merger, it's one which takes place between 2 firms in the same line of business. So let's think about in the Guyana scenario, if banks and DDL comes together, then that'll be classified as a horizontal merger. And one of the reasons why firms will engage in horizontal mergers is, one, to make the business larger, to increase their market share, and hopefully as a result of the merger, then they can derive economies of scale. There is then vertical mergers, which, as it suggests, verticals, it's top down. You have one level above, one level below, 2 companies at those levels combining together, right? So it involves companies at different stages of production. Even in the service industry, it might be 2 companies at different levels of the service industry. right? And the aim is to achieve synergy via cost reduction. If we think about the Guyana scenario, then let's say back in the days when Gaisuco really produced alcohol for the rum making industry, then if Gaisuco and let's say DDL had come together, then that could have been classified as a vertical merger, simply because Gaisuco provides the raw material for the rum, and DDL would have produced the rum. So that's an example of a vertical merger. If we think about, right, so that's one I can think of. Then we have conglomerate merger, which involves companies unrelated line of business. And essentially why they come together for a conglomerate merger is that they seek synergy, which enhances value, performance, and cost saving. So these are two businesses that are totally unrelated, but for some reason or the other, they think that if they come together, then they can, the value of the newly formed entity could be increased. Performance might be able to increase. Let's say the company might have a particular philosophy of operating that might be more people focused. And if the two companies come together, then they think the benefits of being people focused in one company could rub off on the other company. So that's an example of a conglomerate merger. Any questions? Feedback? All right. Then there's some motives, sensible motives of mergers. One is economies of scale. So a larger firm may be able to reduce its per unit cost by using excess capacity or spreading fixed costs across more units. Right. So economies of scale is one sensible motive for a merger. Then there's economies of vertical integration. So control over supply may reduce costs, right? So if one producer now has control of a supplier, then they can decide what's the input cost for them now. So in effect, they can get their products to market at a lot cheaper, and then charge whatever markup that they feel comfortable that will make them competitive. But overall, the integration can also have the opposite effect, right, of actually deriving economies. And then there's complementary resources. Merging may result in each firm filling in the missing pieces of its firm with pieces from the other firm. So some companies, or you might have a case of two companies operating inefficient because they are missing a vital resource in their operation, and one company may have what the other company doesn't have. So if they come together, then and combine the resources, it becomes complementary. And so they remove those or fill those holes with cogs from each other's company. So for instance, you might have, if we look in the technology space, you might have a company that is producing computers, another that is producing the processors, and if they come together, then they might be able to produce better computers, because you might have a case where the producer of the computers might be restricted from purchasing from a particular producer of the processors. So it's in that case, it's just one company slotting in what the other one doesn't have, right? More sensible motives. Strictly speaking, some companies may have excess funds, so it might be better for them to pursue mergers, since the pursuit of those mergers might derive positive net present values, right? So you have excess funds, you look around, you can't find enough projects with positive NPVs, then acquisition of another company or merging with another company might be the next best option. Or even if you have projects with positive NPVs, having worked that out and compare that to the potential benefits of a merger, then you might find that it's better to spend that surplus fund on the mergers. Then eliminating efficiencies. Some companies, if they are left with too much funds, then inefficiencies may creep in. So management may become wasteful with the excess funds that they have. They might make poor decisions. They might undertake projects that do not optimize returns, right? And as such, they will harm the value of, um, of the company. So another sensible motive is to eliminate all those possible inefficiencies by engaging in merger activities. And then there's industry consolidation. Some industries have so many players in it, and in an effort to exert more pressures on other stakeholders in the industry, it might be more sensible for them to merge and becomes larger and thus uh, have more bargaining strength. So consolidation of industries is another sensible motive for mergers. Any questions? Feedback? All right. But then there are some dubious reasons for mergers. So one is diversification. Oftentimes when mergers are undertaken, the reason of diversification is preferred or posited, but oftentimes or it's essentially easier for a shareholder to obtain diversification than a company. So for instance, if a shareholder wants to diversify their risk, then they go to the stock market, buy the shares. It's a pretty straightforward transaction. But when a company wants to diversify on behalf of the shareholders, so they're saying, okay, we're going to merge with another company, it entails uh, lots of efforts and time and resources. So it's actually cheaper for a shareholder to diversify by him or herself than for an entire company to diversify on behalf of the shareholders, right? Then there's increased earnings per share, which we call the bootstrap game. So in this scenario, the argument that is posited is that if this particular company acquires another company, then its earnings per share goes up, right? But it doesn't go up because of the actual performance of the company. It goes up because of the dynamics of the two price earnings ratio. So the acquiring company has a high P ratio, and the company that is being acquired will have a low P ratio, right, due to the number of shares. And you might have a scenario where the value of, and this is hypothetical, but you have the value of 2 shares in the selling company is equivalent to 1 share in the acquiring company, right? So what happens is that when the merger occurs, then the earnings of the two companies are combined, but then the acquired company, let's say they had 1,000 shares, when it comes into the acquiring company, those 1,000 shares becomes 500 shares. So the same earnings from the acquired company that was being divided by 1,000 shares is now being divided by 500 shares. So what it does, it ramps up the earnings per share in a superficial way, right? And the only way that could be maintained in the long run is if they continue doing acquisitions of similar like. So they acquire companies which have earnings per share that is twice as low as them, right? So what it gives to the market is a false sense of a rise in earnings per share. And then finally, there's the argument of a lower financing cost. So the argument forwarded this time is that if companies combine and they merge and they get larger, then they have more bargaining power with lenders or financiers, and the result might be lower financing costs. But oftentimes in reality, that is not true. Any questions? All right. So how do we estimate merger gains and costs, right? So the first question you ask is if there's an overall economic gain to the merger. under the terms of the merger make the companies and its shareholders better off. So the formula we have for, which will tell you whether or not you have gains in a merger, is what you're saying here is the present value of the combined companies should be more than the present value of the companies separately, right? So we enter here into the sphere of, and concept of synergy, where we're saying the sum of the two parts is, well, right, the sum of the two parts is more than the two individual parts. So in this statement here, you're saying if you add the present value of company A and company B together, it should be more than the sum of this. So if company A present value was 5 and company B present value was 6, you're saying when you put them together, they should not be 11, but they should be 12 or 13, right? So the whole concept of synergy. So together they should be worth more than if they're held separately. So to calculate the gain is, you look at the gain as the present value of A and B combined minus the present value of A plus B, right? So separately, and the gain would be the change in the present value of AB, right? The cost, on the other hand, would be the cash paid minus, and we're assuming here that B is the company being acquired. So the cost would be the cash paid minus the present value of B. And the net present value of the whole transaction, of the whole merger, would be the gain minus the cost, which is the change in AB minus the cash minus present value of B. Pretty straightforward. Just to put these to figures, so in this example, we say two firms merge, creating $25 million in synergies, right? If A buys B for $65 million, the cost is $15 million, right? So in this example, the present value of A is taken as 200, well, this is millions we're dealing with, right? The present value of B is 50 million. The gain, which is the synergies, is 25 million, which we're given. So the present value of AB would be 200 plus 50 plus the gain, right? The synergistic gain. So that'll be 275. And the cost would be the cash paid, which is 65, minus 50, which is the present value of B. And you have a cost of 15 million, right? So the MPV of that would be the synergistic gain minus the cost. So you'll have 10 million being added, right, to A. So that's what is added to A, the net present value of what is being added to the company A. Work another way, you could look at it as the wealth with the merger minus the wealth without the merger. So the wealth with the merger would be 275 minus the consideration that you pay minus the wealth without the merger. So this is with held separately, and you should get the same $10 million. Right. So that's just a numerical example. Any questions? Any questions on this example? So just to go it again, so we said two firms merge, creating 25 million in synergies. So essentially what we're saying, the 25 million in synergies is when we add the present value of the two companies, we get, and we make them one, we get $25 million more than what they are valued individually, right? And it says if A buys B for 25 million, the cost is 15 million. So if you buy it for 50 million, the cost would be, the amount you pay would be the difference between what you buy it for and the cost. So that'll be 50, right? So that's how we end up with the present value of B being 50. right? And then we were told that the present value of A was 200. So to get the gain, we're told that is also 25. So the present value of AB combined would be 275. The cost that we paid was 65 million minus the present value of the company. So we end up with 50 million. And the MPV that's being added to A would be 25, which was the synergistic gains minus the cost of 15, so you get 10. Worked another way, we can look at it as the wealth with the merger and the wealth without the merger. So the wealth with the merger would be the present value of A and B minus the cash we paid, and the wealth without the merger of A would be just the 200. Minus that, you work that out, you should end up with 10 million. So that's the value that is being added to company A, the acquiring company. Good. So that's just a simple example of how mergers are, how the value of mergers are calculated. Now we look at some measures that companies, shareholders will take to prevent mergers or acquisitions. So first is a proxy contest. So a proxy contest is a proxy gives the right to vote for another shareholder, right? And you know, in large companies that the shareholding is so dispersed that you have many shareholders. So it becomes a challenge to organize shareholders. And as a matter of fact, many shareholders don't come to meetings and so forth, or a majority. So what it means is that for the decisions which are taken at AGM, so you would imagine that a merger would be taken at the AGM or a special organized meeting. It wouldn't, the board of directors won't be able to just execute a merger as a board. More than likely, they have to go to a shareholder, to the shareholding or to the shareholders to get that authority to execute that merger, right? So those shareholders who are active and up to date with what's going on with the company will first seek to get that proxy from other shareholders so that they can vote on their behalf. So in that way, they can, you know, block the merger from going through, right? So the first thing you do to stop mergers is to get proxy from other shareholders so that they have enough votes to block that that merger. And one way they seek to block that merger is by installing a board of directors that will obey their wishes. So they will remove, if there's a case of the shareholding, the current board of directors want to pursue that merger, then they'll remove some shareholders and replace them with the ones that are more favorable to their wishes. Right. And then there are takeovers. Right. So in takeovers, they tend to offer directly to shareholders. If successful, new owner is free to make any management changes. So what the acquiring company will do is to go directly to the shareholders and offer them to buy out their shares. So in that case, then they just, if the shareholders desire, then the acquiring company will just take over without even having to go to get board approval for that, right? And once the acquiring company is successful in buying enough shares directly from the shareholders, because of course the shareholders could sell their shares to whoever they wish, right? Even on the open market or even privately, right? But there's a couple, and this table presents a summary of the takeover defenses. So the first one, the four sets are postures that you can take pre-offer. So that's before the acquiring company issues an offer. So there are some postures that you can take. So the first one is what we call staggered board. So in this case, you have a board that is rotating and you have you have directors rotating or retiring by rotation. So typical for companies like banks, Daimler Mutual Life. I also, well, I know the Institute of Chartered Accountants of Ghana, they do that too. So you have, like, typically it's about 1/3 of the board retiring. So you'll have about 2 or 3 directors every year retiring, and then they're eligible for elections. But what it gives is uh, if someone wants to change a board, the option to change it just 2 or 3 directors at one time. So in doing this, it prevents a mass change of the board, so that like a merger could just go through. So if there's a talks of a merger or plan for a merger, by having a staggered board, it will take maybe 2 terms. If a term is a year or a term is 2 years, how many it might be, it take 2 terms before the persons who want to pursue that merger could have enough persons on the board to execute that merger, right? So that's one way of preventing it. So you wouldn't be surprised by a merger, and you have enough time to uh, make whatever or take whatever action you think is necessary to stop that merger, right? Then there is something called supermajority. So typically, uh, the shareholders have to approve that merger, and it doesn't require a simple majority. So not just more than 50%. They will enshrine in the incorporation documents of the company that, for example, for specific strategic activities, for example, a merger, that you will require 80% shareholders approval. Right. And then there's a fair price approach, which mergers are restricted unless a fair price is determined by a formula or appraisal is paid. So also included in the articles of incorporation might be a formula which calculates a fair price to shareholders. Typically, that fair price might be the market price plus a premium, right? So unless that value is met, then the merger would not go through. So shareholders who want to out has to be paid that before the merger could go through. They have restricted voting rights, where shareholders acquire more than a specific portion of the target, right? And that's a target company, have no voting rights unless approved by the target's board, right? So you can acquire how many shares you have, but until the board gives you that approval to vote, then you have no voting rights. So despite having acquired all those shares, you still have no say in the way forward for the company, unless the board approves it, right? And then there's a waiting period where unwelcome acquirers must wait for a specified number of years before they can complete the merger. So if it's a hostile takeover, some companies will have, again in the Articles of Association, that a hostile takeover must occur over so many years, right? There's also what we call a poison pill, where the existing shareholders are issued rights that if there's a significant purchase of shares by a bidder, it can be used to purchase additional stock in the company at a bargain price. So here in the poison pill situation, if a company comes in and wants to buy shares in the target company, then those existing shareholders in the target company have the option to buy more shares at a bargain price, which is typically set way below the market price. So what that enables is that those existing shareholders, their shareholding could increase, right, and thus prevent the acquiring company, or at least challenge them, make them think again about acquiring the target company. Then there's a poison put, where this one focuses on debt. So it says in that debt agreement that if the company is acquired, then on acquisition by another company, all the debts have to be settled immediately. So that could also be off-putting to acquiring company because of the additional finances that liquid finances that they'll have to front. So before they can go through with that merger. Then post-offer defenses. So now we're in a situation where the shareholders of the target company has been issued an offer, and they have a couple of things that is available to them, remedies that is available to them. So there's litigation, right? So the shareholders could argue that the acquiring company, if they acquire the target company, then there will be antitrust issues. So we can say the typical antitrust issues that they make the industry uncompetitive. So the number of players in that industry becomes so small that they might have a virtual monopoly, right? So which violates antitrust rules and laws. Then you can have asset restructuring. So the target companies buy assets that bidder does not want, or that will create an antitrust problem. So having received the offer from the acquiring company, then the shareholders of the target company can instruct management to go buy assets that are not attractive, or buy assets that will make this company now a monopoly. So then the merger cannot go through. And then there's a liability restructuring where the target issues shares to a friendly third party. So and increases the number of shareholders, or repurchases shares from existing shareholders at a premium. So in this last one, the liability restructuring, the target company will now go to find a friendly company, a company that is or who would acquire shares in them but would not interfere in the daily operations, but will just have that share to vote for that in favor of that target company for whatever will happen in the future, right? So it's a company that is sympathetic to the target company, right? We'll acquire those shares just to ward off and a hostile takeover, a company making a bid on the target company. Are there any questions? No questions? All right. Good. So just three more takeover defenses, a little more in detail, or just to recap them actually. So the friendly potential acquirer sought by a target company threatened by an welcome suitor. So that's what you call the white knight. So a couple of years ago, Sumacal had made a play for Banks DIH. And what Banks DIH did is that they went to Banks Barbados, and they got Banks Barbados to buy shares in Banks DIH, and Banks DIH also bought shares in them. But by Banks Barbados buying shares in Banks Guyana, it made coming to that necessary. I don't know what is Banks DIH, what their incorporation rules say, how much percentage of the shareholders should vote before takeover could happen. But by Banks Barbados acquiring those shares, it prevented Sumacal from meeting that threshold, even if all the other shareholders said, well, yes, we would like Sumacal to take over Banks DIH, right? So that's what you call a white knight defense. And then the sharp repellent is amendments to company charter, or we call articles of incorporation, made to forestall takeover attempts. And then we went through the poison pill. So that's measure taken by a target firm to avoid acquisition. For example, the right of that existing shareholders to buy additional shares cheaper, and thus will have more say against a merger. So those are three defenses in little more detail. Right. So just an example of the poison pill. Let's say if banks had that in their charter, or what we call articles of incorporation, or they would have said, well, look, if there's a takeover attempt by another company, then all existing shareholders could have so much or so many shares at market price less 40%, something like that, right? Merger waves and merger probability. So who usually benefits from mergers? Usually it's the shareholders of the target company, and lawyers and brokers, simply because lawyers and brokers, there are significant fees and significant legal paperwork that has to be done in mergers. So lawyers and brokers make significant amount of money. And the executives of the acquiring firm, because oftentimes executives of acquiring firms, especially in developed countries, their pay is tied to things like market share and growth of the company. And one way of a company growing is by acquisition. So it's not necessarily you going out and selling more and having an excellent sales strategy or excellent marketing strategy. You can also have that growth by acquisition. So oftentimes the beneficiaries are the executives of the acquiring company, the lawyers and the brokers, shareholders of the target company, because oftentimes the shareholders of the target companies are paid a premium for their shares. Right? Who usually loses in a merger? Then it's the shareholders of the acquiring company, simply because the acquiring company more than likely will pay premiums, so they'll overpay a little they'll overpay for the acquisition. So of course, there's less funds that is available to the acquiring company shareholders, so they suffer. The executives of the target company, they also loses, because oftentimes they are the ones that are let go. Right? You'll imagine if company A is acquiring company B, more than likely the managers of company A will become the managers in company B, and so the managers of company B will be let go. And then employees due to restructuring. When companies merge, then there is a lot of realignment and lots of looking for synergies. So there's restructuring, and a lot of jobs are consolidated. So some employees are let go normally when mergers occur. So that's for mergers. And then any questions? Are there any questions?
No, sir.
All right, good. So just 2 more slides, so we won't even take a break. I should actually make this last chapter just a reading chapter, not even teaching it. But it just gives an example of how and who controls companies in 2 major industrialized nations. So you have Japan and Germany. So in Japan, they have something called keiretsu. So keiretsu is an approach to control of companies and ownership of companies where several companies just have a portion in each other. So it makes it and these are companies that are sympathetic to each other. So in Japan, you'll have Nissan having a little bit in Toyota, and Toyota having a little bit in Honda, and so forth. So they're all intermixed, intermingled. But that is their way of warding off any acquisition attempt by an outside company. Right? So you seldom find European countries or American companies successfully acquiring Japanese companies. It just really don't happen because of keiretsu. And then one way they're also controlled in Japan is what we call Abenomics. So I can't remember his first name, but Abe I think he's the current prime minister of Japan, but he has a peculiar way of how he runs the economy. He even uses reflationary techniques, lots of incentives, but that's the approach he uses to control and have ownership in Japanese companies. Then there's a stock exchange in Japan, which helps with control and governance. And then, of course, there's a corporate governance code of 2015, again by Prime Minister Abe, who in the recent past has really had a significant impact on the way businesses are conducted in Japan, both ownership and control. In Germany, though, it's a little bit different. The banks own and control most of the companies, and one of the significant banks is the Deutsche Bank. And then we have Daimler. AG means incorporated. So where you have in Ghana we have INC. AG means incorporated. But Daimler is a huge automotive company. But those three institutions, well, the banks, the Deutsche Bank, Daimler, those are the three institutions which significantly, which controls most of the companies in Germany. And there's the final slide, just to look at how the shareholding of Daimler has changed from 1990 to 2014. So in 1990, you have 3% of it was owned by Renault, Nissan. You have 6% by the Kuwaiti Investment Authority, and 90% of it was widely dispersed. What happened eventually in 2014 is that there is a lot more consolidation. So you have the Deutsche Bank comes into the picture now with 28%. You have the Kuwaiti government goes up to 14%, and then you have Mercedes now having 25%, and then you have a dispersed shareholding of 32.37%. But it just shows you how it has changed significantly from 1990 to 2014. But we should also take into account that 1990 was the early days of unification of Germany. So that would have also had some impact on the shareholding of Daimler to 2014, because you had more East German companies coming in, and some, though not as wealthy as the Western counterparts, were also making plays in the market. So good, ladies and gentlemen, this is all I have for you this afternoon. Any questions?